I'm going to go ahead and start with some opening remarks. There's only two things on people's minds today: making ends meet and making meetings end. So we're going to do our best to stay on schedule. Welcome to the Hospitality Law Conference, Washington, D.C., Day 2. Today is September 17th, 2025. Welcome to those of you here in the prestigious Army-Navy Country Club in Arlington, Virginia. Welcome to those of you watching live but remotely, and welcome to those of you that might watch this program on demand in the future. My name is Stephen Barth. I'm the founder of HospitalityLawyer.com and a professor at the University of Houston. I'd like to say thank you to Kensington Vanguard, the National Title Company, for their generous support for our breakfast today. Let's do a quick safety and security review. Yes, thank you. Let's do a quick safety and security review. There is not a fire drill scheduled today in the club, so if a fire alarm goes off, it's the real thing. Just please keep in mind that the elevators will not work. There is stairs, as many of you probably saw as soon as you came in, will take you right down to the lobby. But if you also exit any of the doors at the back of this room, you turn left, go straight out to the terrace. There's an exterior staircase that will take you down to the ground level. So, and restrooms, by the way, are just outside and to the left of this room. We do a lot of social engagement at HospitalityLawyer.com, so I hope you'll join us today in sharing the information. And those of you that are watching remotely, you are welcome to do so as well. By joining us today, whether it's remotely or here in person, you have access to HospitalityLawyer.com for 1 year. You can scan this QR code, and that will get you to the place where you can create a complimentary login that will be good for the next year. We also are very proud of our collaboration with MyLawCLE, a national CLE provider for the lawyers in the room. We have also created, in conjunction with MyLawCLE, a hospitality law portal. So now you can access all of your CLE relevant to hospitality at MyLawCLE. That QR code will take you to a spot for you to sign up and purchase access to MyLawCLE. For attending this program, as well as yesterday, there is continuing legal education credit available. Everything is really straightforward except for Virginia. Those of you that practice in Virginia, you know that. But if you have any questions, please see Marilyn and or the MyLawCLE folks here at the audiovisual table. So Day 2 of our program, this half-day program, is focused on Let's Make a Deal. And so let's just take a quick peek at what we're going to be doing this morning. We're going to start with some opening remarks and then the market outlook for Panel 1 and deal-making trends. Then we'll roll into Panel 2, an anatomy of a hospitality acquisition in today's current market. We'll take a quick break supported by Cozen O'Connor. And then we'll come back for Panel 3, Financing the Future, and Panel 4, Legal Landmines and Successful Outcomes, followed by a Dealmakers reception out on the beautiful terrace, supported by Ancora, Dimension Hospitality, and Fisher Phillips. Now, to start us off, to give us just an overview of the deal landscape as it exists today, is Mr. Bradley Burwell, Executive Vice President of Colliers.
Good morning, everyone, and thank you to Stephen and Hospitality Law Conference for inviting me to provide a brief overview of the current deal landscape as an introduction to today's panels. We have a distinguished lineup of experts who will explore hotel transactions, capital trends, and deal structuring throughout the day for you all. But to set the stage, I'll outline the current transaction environment and highlight just a few key trends. Can we do the slide? There we go. Perfect. There's a lot there, I know. But just to kind of summarize, in 2024, approximately 1,700 hotels sold throughout the United States worth $25.5 billion. In the first half of 2025, 823 hotels have traded hands worth nearly $12 billion, aligning with the first half of 2024. Over the last year, we've seen a 4.5% decline in total hotel sales volume, but about a 25% drop in the number of properties sold. And looking at the market with a broader lens, I would say sales volume in the last 12 months is 32% below the 15-year annual average, which is about $36 billion a year. I'd also note that although the third quarter's numbers are not out yet, the 12 months as of September will likely be down another billion or two. Regionally, I have some statistics up here that transaction volume across the United States remains well below historical averages. The South and Midwest have experienced the smallest declines and even shown year-over-year increases. This reflects post-COVID investor shifts towards Sunbelt markets, coupled with less volatility in the Midwest smaller markets, which are less impacted by macro trends. Conversely, gateway cities on the East and West Coasts have experienced significant turbulence over the last 5 years and are, in my experience, much more volatile investment markets anyway. Another notable shift is the decline in the average deal size over the past 24 months. While a typical hotel sale or a typical sale of an individual hotel hovers around $15 million, and it has for, as far as I could tell, 7-8 years, the average deal size has fallen 30 to 40% recently. You can see this as portfolio volume is down more than 45% from historical averages, and we haven't seen an entity-level transaction in the last 20 months, which is particularly important to this group. I'm going to simplify the complex transaction market into two factors. First of all, the types of capital, both buyers and sellers, and the cost of debt, which brings me to the next slide, capital trends today. Our third panel, Financing the Future, will delve into equity and debt capital and talk about this a little bit more, but I'm going to highlight just a few insights. This big graph that looks very colorful shows buyer capital sources over the years, and it illustrates a cyclical pattern, even though it may not at first glance. Sellers on the other side of deals are consistently mixed, so I haven't put them up here. I would say an apocryphal statistic that I heard years ago states that 80% of hotel investors lose money, while the remaining 20% make a lot of money and recoup all of the 80%'s losses. And if that's true, private capital, which is owners, operators, high net worth family offices, are all a meaningful part of that profitable 20%. You can tell that they tend to buy when transaction volumes are low and performance is down during crises like the Great Financial Crisis, COVID, or one could dare say today. By contrast, cross-border and REIT capital tend to invest when asset performance is strong. Interestingly, I would note that these groups are the right buyers when debt is expensive and operating performance is weak, as they use low leverage and they are long-term holders. However, they rarely invest in downturns. REIT stocks are often lower when interest rates are higher or the economy falters, and international investors pull back capital with negative economic trends globally and favor fixed income when interest rates are high. I would note that between 2019 and 2024, REIT acquisition volume is down 46% from the levels seen between 2010 and 2018. So they're doing half as many transactions as they were really pre-COVID. Host was not rewarded by the public markets for its excellent acquisitions in the last 24 months, both in New York and Hawaii, and even in Nashville. The major asset aggregating REITs of the last 10 years are all but silent or else in sell mode. Braemar, as everybody I'm sure has seen, and maybe some of you are participating in, is on the market as shareholders recognize that its assets values exceed the public valuation. And just this week, one of Sunstone's largest investors requested the company to start asset liquidation. From a cross-border perspective or international buyer perspective, each cycle has always had a dominant foreign player. The Middle East came out strong in the early aughts. The Chinese, and specifically Chinese insurance companies, came out in the early teens. And since COVID, we've seen investors from the UK, from Canada, Singapore, and Korea, who have all tested the hotel market for various reasons, but not one has emerged as a dominant force. I'm hoping that in today's panels, somebody will shed light on who the next major foreign investor is going to be so that I can call them later. Finally, institutional private equity emerges cyclically, I would say like a cicada. Private equity value often hinges on cheap debt. Recessions, downturns, crises lead to this cheap debt. And as you can see, after the great financial crisis and COVID, which are marked there with some red arrows, institutional equity funds become the largest investor in the space, deploying significant capital in a very quick period, and then they dig back in and wait for the next cycle. So now that we've gone through a couple of years of low transaction volume, are they going to come back out? We've seen, obviously, Blackstone make a major acquisition down in Miami last week, and earlier this year they've made several pretty big deals, so maybe that's a sign. Let's go on to the next slide, please. In my, frankly, oversimplification of the transaction landscape, debt is the second key factor. And today's debt markets are both liquid and more constructive than the equity markets. Lenders seek stable, predictable income that thanks to high interest rates, they're enjoying the strongest yields in the last 35 years. Lenders are much more mathematical in their analyses than equity investors, and we are at an interesting point in the cycle where we are seeing lenders value assets greater than buyers. This little chart that I put up here that I guess it's not too hard to read shows average hotel cap rates by year. And currently, investors value hotels around a 9.5% cap rate. This is compared to a historical average that, even though it doesn't look like it, I would argue is about 8.5%. Mr. Lesser will have a much better opinion of that than I do. But lenders are still underwriting the value of hotels on this historical average. And that means that they are valuing assets 10 to 12% higher than buyers are today. And as a result, lenders are often offering borrowers 72 to 75% of loan to market value, yet they're pricing it on the appraised value and on a loan at 65% of the appraised value. Next slide, please. I just want to hit on a couple of other macro trends that is impacting underwriting for investors today. First of all, travel trends. Remote work from hotel rooms during long weekends, which was driven by Zoom and flexible office policies and demographic shifts, has all but waned. International tourism to the U.S. remains below pre-COVID levels, with fewer high-spending, long-stay visitors. This trend, I think, is going to continue with both rising visa costs, inflation, and global sentiment. On the upside, airport traffic, as reported by TSA, continues to rise steadily, indicating corporate travel continues to rebound. I will tell you that last night my flight was delayed. I did a red eye, and the plane was totally full, and I couldn't get a bag in, and I was in boarding section 1. So that just goes to show how crazy it is. And it also tells me that a lot of frequent travelers are traveling, which is typically your business traveler. In terms of labor, inflation and constrained low-wage labor pool will continue to pressure operating costs. And then in international relations, which I think is much more about stability. Market sentiment shifted rapidly with initial optimism at the start of 2025 that faded by April, and although uncertainty persists, confidence is gradually returning. And by early next year, I believe that geopolitical concerns will have a smaller impact on underwriting as investors and lenders adjust to what we could call new norms. Go on to the next slide, please. Our first panel today has a great set of advisors that are going to be talking about the market outlook and deal-making trends. But before we move into that in just a couple of minutes, I want to outline a few ideas and topics that we are seeing from investors, buyers, and lenders today. First of all, what do investors want? Geographically, they are still particularly focused on politically red cities with major medical, educational, sports, and entertainment venues. From an asset perspective, I would say that cash is king. Stronger in-place income attracts more interest. Today, investors prioritize assets that cover debt service without requiring additional capital rather than repositionings. And then finally, deal sizes, as I mentioned, are currently smaller, but I anticipate that in 2026, we will see more substantial transactions, both single asset, more portfolio deals, and then the thing that's really going to push the size of the deal is we will see a return of entity-level transactions. How is underwriting changing? Our second panel, Anatomy of a Hospitality Acquisition, will explore this. But I'll note that the cost of equity has risen over the past 2 years. Leverage IRR targets today are now in the low 20s, up from the high teens at the end of the last decade. And then finally, the word that perks everybody's ears, distress. Everyone wants a distressed deal. I think that this is so much so the case that buyers typically overpay for distressed deals. Well, let me just set the stage here. CMBS delinquencies increased from $3 billion in the fourth quarter of 2023 to over $5 billion in the second quarter of 2025. Furthermore, 8% of loans are currently reported to be distressed, which is the highest level not since COVID, but since 2010, since the Great Financial Crisis. There are two types of distressed deals, those that are operationally distressed and those that are overcapitalized and financially distressed. Operationally distressed deals are relatively consistent. They're functionally obsolescent hotels, and those just are naturally kind of coming all the time. And I used to point out that almost all of the distressed deals purchased in 2021 were distressed before COVID. But to many investors' excitement, and I'm sure to many of you, to many of your clients, we are now seeing bigger cracks in the dam holding financially distressed deals back. These are the deals that were built for too much money. They were the deals that worked when debt was 3.5%. Hotel operations have generally stabilized across markets, and although the cost of debt is expected to continue to slowly become less expensive over the next year or two, it is not expected to fall dramatically. And these factors are leading lenders to call in their loans. They are productively working with borrowers, as we have seen, because they don't want the assets back, to either sell or refinance these deals in an efficient manner. That can be achieved by allowing the borrower to control the process if it's a short sale, working to alleviate tax implications and financial burdens for the borrower, covering operating shortfalls, obviously, and we are seeing consistently that These lenders are providing some type of bridge loans to buyers or anybody who brings in fresh equity. With this broad overview, I'm going to pass the stage on to our moderator today, Stephen Shapiro. Stephen directs the Hospitality and Tourism Law Program at American University here in DC, and he teaches courses on industry economics, franchising, development, data security, risk management, and employment law. Stephen and Stephen Barth, our host here, collaborate on hospitality lawyer events and teach together in France. I encourage all of you to reach out and to connect with them about upcoming programs and also ideas of future programs. With that, I wish all of you a fantastic day, and hopefully it will get sunny for the terrace this afternoon. Stephen, the floor is yours. Thank you.
Hi, good morning. I'm going to ask our panelists to come up for the first session. We have Jared Allen, Dan Lesser, Hector, and Kyle Stevenson. For me, our session, which was a great setup by Brad, has three sort of overarching topics. It's let's make a deal, so acquisition of properties, and then along with that, we'll have a conversation perhaps on franchising. We're going to be looking at funds. Where's the equity? Where's the debt, which Brad talked about also. New development, and then our final session will be on, it's on risk, but it's also going to be gremlins. Where are things hiding? I'm going to ask our panelists to introduce themselves, but I'll ask them the first question, which is, we get so much analytics, macro, micro. So if you could quickly introduce yourself, your work, but what are you looking at, Kyle? What are all this information, RevPAR, where's the money, where are the deals, where's the geography? What are two or three that stand out for you? We'll go down the line, and then we'll have the next question, or as you wish on any of these topics. Kyle Stevenson.
Good morning, everyone. I'm Kyle Stevenson with Berkadia. We are a joint venture between Berkshire Hathaway and Jefferies, the investment bank. My company does a lot of things, but one of the things we specialize in is hotel brokerage and hotel debt placement, like several of the other panelists and Brad as well. My what do we do, what do we see, I guess, since COVID happened in the hotels, the hotel world just completely shut down. I realized I really couldn't help owners. Everyone that I knew that was a hotel owner had just lost value, and it was going to take time for it to come back. So I figured the people I needed to help were the lenders. And for me, I started chasing after the distress that we mentioned a little earlier. And I think what I'm seeing is that, just as Bradley explained it, there's operational and then there's the capital side. And to me, that's where the opportunities are today.
Okay. Also setting up the other sessions, we're dealing with different professionals. We have title, we have environmental studies, engineering studies. You're dealing with the owners, you're dealing with the brands, and you're dealing with the lawyers. As we go along, how are you integrating and keeping your eye on those matters? But first, a quick introduction. Hector Medina, if you don't mind.
Sure. Good morning. My name is Hector Medina. Been in the industry for about 19 years. Probably about 15, 16 of those have been on the consulting side. And the balance, I work for a hotel company, Apple Leisure Group, which was acquired a few years ago by Hyatt. I was analyzing new markets for them. Currently, I'm with Ancora Consulting. We typically assist clients with a whole array of necessities. Primarily, we've been doing a lot of litigation support work, valuation type analysis, performance improvement, and when it's available, M&A, assisting them with the due diligence in M&A deals. I think with the line of work that we do, a lot of the times what we need to, when we look at all of this data that's out there, it's pretty much making sure that we're able to tell our clients what to expect in terms of value. So obviously getting a deep understanding of what those cap rates are for specific markets. And in addition, from a performance improvement perspective, being able to understand what's happening in each of those markets to be able to really tell them what to expect from a top-line perspective for the next 12, 24, 36 months, in addition to what their bottom line could be.
Great. There's a couple of AU law students here. I'm looking right at them, and a graduate. You'll see in these conversations and as you talk, there's so many different career paths inside of hospitality. Start out in one direction, you head another, but you'll see from all of these conversations, I think Kyle was in banking earlier in his career, pathways. Sorry, Jared.
Hi, good morning. Jared Allen. I'm with CBRE Hotels. I sit in our Dallas office and focus on institutional investment sales, really across Texas. And kind of to your point, I've had a longer career than that. I started out in consulting and valuation and spent some time with Hector at Ankara and am now with CBRE. So in terms, I think your first question, kind of what the metrics that we're looking at, like most investors, I think just are hyper-focused on in-place yield, so just NOI. And outside of that, I think really having a good understanding of supply in your market would be kind of the top two, I think, that we're looking at. So.
Great. Dan Lesser, in addition, well, you'll talk about your work, but Dan, I think like all the panelists, you're at conferences, you're in the lobby, you're meeting with people, you're sitting having lunch. The mood, I mean, it's not something that we can replicate, but if you would address that as well.
Sure. So good morning, everybody. And thank you, Stephen, for inviting me to participate. I think the first time I did this was 30 some odd years ago in Houston, so great to be back. I'm the co-founder, president, and CEO of LW Hospitality Advisors. Let me let you in on a secret. I'm the L in LW. When we started the company, we did not spend a whole lot of time or money to come up with the name. My partner's last name begins with W, so hence LW. Anyway, yeah, hotel school graduate, worked for, by the way, I'm only 20 years old, so the math works. I dye my hair gray for credibility purposes. Hotel school graduate, worked for Hilton for a number of years in operations, and then I was the first hire when Steve Rushmore founded HVS, which back then was Hospitality Valuation Services, 1980, 81, somewhere around there. Again, I'm only 20 years old. The math works, believe me. I spent 13 years there. Then I joined Cushman & Wakefield, started up a hotel consulting advisory practice there that morphed into a transaction business. 11 years there, 5 years at CBRE, doing the same thing, and then 15 years ago launching LW. We have three main silos of business. Silo number one, I characterize as a non-advocacy practice. It doesn't matter who our clients are in that silo. Our findings are our findings. So think valuations, appraisals, market studies, feasibility work, litigation work. We do a lot of that as well. The second silo is a advocacy silo, asset management, and we do traditional third-party hotel asset management where we oversee day-to-day operators. We are not day-to-day operators, or at least everybody in the organization has worked in day-to-day operations, but we don't offer that as a service. Within that silo, we also do a fair amount of receivership work. During COVID, we were the court-appointed receiver for a portfolio of 46 select service assets. Ultimately, we structured a sale to KKR of that portfolio for about $900 million. And then we do a lot of advocacy advisory work for folks who we very respectfully refer to as newbies to the hotel space. And I say thank God every day for these folks, because there's a lot of smart, sophisticated folks who have money, who know and understand real estate, finance, but they come up short on the hotel piece, and that's where we come in. The third silo is a predictive analytics platform, LARC, Lodging Analytics Research and Consulting. If you're not familiar with it, check it out. It's amazing. I mean, we look at all the data that's out there. The mood, you know, it's kind of interesting. I think it's sort of like in life. You can look at the glass half full or half empty. You know, one thing I'd like to just kind of throw out there that I think everybody really should think about is that, in my humble opinion, hotels should be underwritten assuming a long-term hold. And what do I mean by that? Because of the volatility that can exist right? Think about the world looked very different on September 10th than it did on September 11th, or on January 1st, 2020 compared to March 15th, 2020, right? And so with shifting occupancy and room rates that literally change by the nanosecond due to technology, listen, lots of folks have made lots of money with 2, 3, 4, 5-year holds, right? But it could be a dicey proposition. And my point is, investors should be ready, willing, and able, if need be, to hold on for 10 years.
Great. Hector, 2 questions, maybe 3. What are you reading? How do you stay abreast? I read Skiff. I get some of the news briefs. 4 years ago, we were hearing about extended stay hotels. I'll ask Kyle the same question, all of you. And now there are headlines, it's saturated. Dan Lesser 3 years ago was saying San Francisco is getting beat up. It's time to go to San Francisco. What are you reading, and how are you trying to look ahead? You can't lie about the future, but go ahead.
So I guess what I'm reading, or how I try to keep up with news, CoStar is a fabulous sort of information source. They touch up on different subjects, from operations, from financing, from branding. Skift, as you mentioned as well, Stephen, that's a great source too. They provide a more in-depth, I believe, analysis towards certain subjects. And you said the other question?
Extended stay, predictably, I suppose, now hitting a saturation point. 4 years ago, every article said, extended stay is the way to get out of this COVID environment.
I still think there's interest in the extended stay market. Obviously, also, there's been a lot of interest, or continued interest, in select service as well, and I think it's mainly because of where we're at right now in the cycle. Operation costs have gone up because of inflation, and so these product types obviously offer a very low labor very low labor operations, which obviously helped the bottom line. So I think that select service and extended stay will remain popular with investors going forward.
Great.
If I could add.
Go ahead.
Yeah, I think there's a longer runway. The extended stay on the lower end, more economy, has more room to grow because it's effectively multifamily. So you're going to see areas where you would think, oh, it's not really going to work as a hotel, but there's demand because a lot of times the people are literally living there. And so to me, that makes it so that it actually has more potential to grow. And the brands now, all the major brands, Marriott, Hilton, and Hyatt, have come out with a new prototype for this extended stay model. I think it's Studio Res for Marriott, and Hilton's Live Smart. So those, and their salespeople are out there selling them. I mean, there's a lot more coming.
Maybe for this right now or the next round, start on geography. Berkadia is national. Are you seeing, what are your trends? Are you seeing, where are deals being happening?
Well, it feels like the flight to quality is very strong, and I'd love to get Dan's opinion on that, and Jared too. If it's a really great location and it's a compelling property, it sells. Everything else seems to languish, and sellers' expectations are seemingly light years above where buyers are. Would you agree, Jared?
Yeah, I'd say there's still a bid-ask gap, across the industry. I think, for me, sitting in Dallas has been one of the most popular real estate investment markets in the country for the last several years. There's some supply concerns there, but for the most part, I think select and extended stay has been the type of deals that have gotten the most interest. To Hector's point, operationally, they have a bit of a better margin than the larger, more complex full-service deals. And then their price point's just more conducive to a wider range of buyers, from your regional operators to the high net worth private equity groups. I think the full-service deals are out there. They're just not as deep of a playing field for active buyers.
Two questions, or maybe a similar question for you, Jared, and then for Dan Lesser. New development, conversion or change of flags from one brand to another, conversion from an independent hotel to a franchise, and adaptive reuse, which for me is more new development. What are you seeing? Well, let's start with what are you seeing, and then I'll ask Dan the same question. And then
Yeah, so I think the conversion, like the cost of development has made a lot of, smaller developers who typically develop right now, has pushed them into acquisitions. I think they're most focused on the value add type of returns, the conversions, the rebranding opportunities. In terms of development, some of these, like the studio res, the cost of development are still just so high that it's hard for me to even fathom, selling a studio res in a tertiary market for what it costs to build, which could be high, hundreds a key to build. So yeah, I guess we'll see where that goes. But does that answer your question?
Same question for Dan, but I would add, you did receiverships, troubled properties, distressed properties, but same question, adding on troubled properties.
I mean, at the end of the day, it doesn't matter whether you're investing in a hotel or whatever, right? It's, in my mind, it's all about what's your basis in the deal, right? And there's opportunity, in my humble opinion, across all subsectors within the lodging industry. If you take a big look, I don't remember ever a period of time where hotels were perceived as more desirable assets than office and retail, particularly office, right? I mean, think about it. Logically, 10-story office building with 10 tenants that sign 10-year leases, and they're all creditworthy, right? Once you lease it up, you know what your revenue is going to be, then you know what your expenses are going to be, right? It's an annuity. Hotels don't work that way. There's opportunity. The hotel industry always has been, probably always will be, a street corner neighborhood business, right? So we all talk about national averages, and that's great, right? And we all talk about top 25 markets. That's also great, right? But think about where we are here, Washington, D.C., right? The market, the hotel market in this immediate area where we sit right now in Arlington is a whole different market than downtown D.C., right? The last thing I would just kind of throw out there is that, when you look at sophisticated, knowledgeable, and successful investors in the hotel space, I think the poster child is Blackstone. And if you look at them and what they've done over the past 30, 40 years in the hospitality space is, they're never, just buying or selling. They're always buying and selling because they don't time markets, they time deals. And then if you also look at what they're investing in, they invest in select service, extended stay, but they also just bought that behemoth, that incredibly well-conceived, whatever that is, in Port Charlotte, Florida, some monster hotel resort supposedly that never made any sense. They bought it for 25 cents on the dollar. So there's opportunity.
They bought the East too, remember, in Miami? They bought the East.
They bought the East? Yeah, who just, yes, thank you. That just happened, yep. Go ahead, Kyle, you got it.
No, I was just going to say, it's like, but they never feel badly, like they bought Motel 6. And everybody's like, oh, I would never buy Motel 6. But hey, they made money. And they bought Hilton. I mean, so you're right. It seems like they have the Midas touch. They can't do anything wrong. But I think a lot of people get it wrong. A lot of people don't figure it out. Why do you think that is? Why is it that so many, Bradley was saying that 80% of the transactions, they lose money. So it's harder.
Hotel space.
It's harder in the hotel space, right?
So,
I think maybe it's the business aspect of what we do. You were talking about the office complex, which is a perfect example of the annuity. There are very few annuities in the hotel world, but I think that's what causes the opportunity to make great wealth, and unfortunately, there are great losses as well.
So I have a detailed agenda, and I'll now skip from it. Sorry, guys. Jared, I'll start with you. The topic is, in general, leadership. You all have been in this industry quite a while. It feels to me that Marriott is now making a change in its culture and its leadership. it's finally, in my view, acknowledging it's a franchising operation. Bonvoy, Hilton Honors, all the rest. Do you have any thoughts on what are the hotel brands? Are you seeing the same thing I'm seeing? And is it having a change on the community? The community doesn't matter. They want the brands. So here's my ambush question for you, Jared. Unless anybody else wants to take the question.
I guess I'll just speak generally, and we'll see how close I get to answering the question. I think from owners' development perspective, I think brands have continued to grow through adding brands, which is not necessarily great for individual markets when you have two brands that are supposed to not compete against each other, but absolutely compete against each other. In terms of Marriott's kind of change, I'm not sure I could speak to that. Maybe Dan or Kyle would have a better perspective. But yeah, I think the brands have definitely benefited the most, I think, in the last several years, just from their ability to grow through, top line revenue and not have the operational expenses that the owners have to.
Hector, maybe on the customer loyalty as driving the industry, any observations from your point of view?
I think that's key in terms of being able to grow your loyalty base. I think Marriott has done a great job of that. And to be able to do that, I think that just recently, earlier this year, they acquired citizenM for about $350-400 million, which I think it's another sort of, it's a different segment that they had, or a different brand that they've had in their portfolio. So they're trying to be able to reach out to that premium, to that different customer base. So I think, if brands think outside the box and to be able to acquire different or to acquire additional members, that would be great. But again, Marriott with citizenM, I think that they hit the nail on the head. It's a small portfolio. I think they only have 8 hotels currently, but with the power of Marriott behind them, I think that they're going to be able to grow that brand and obviously entice more members to come into Marriott Bonvoy.
Question for Dan and then for Kyle. Dan, any of your clients say, I want to start a hotel and I want to be either independent or as independent as I can be? What are you seeing? I mean, I just think of most hotels as going to a brand for reasons that, for me, probably obvious with loyalty and reservation systems.
Well, first of all, before I answer that, if you don't mind, I'd like to ask a question of the audience. Raise your hand if you think the world needs more hotel brands. Nobody in this room? Oh, there we go.
We got one,
Fallick.
Jonathan Fallick in the back.
He's just a rebel, that's all. It's interesting. We're sitting up here. I don't know whether everybody in the audience is active in the lodging sector. Studio Res was just mentioned, right? We all know what Studio Res is because we're in the lodging sector. You ask your friends and family who are not in the hotel business, how do you like Studio Res? They'll be like, what is that? I've never heard of it before. So there's so many brands. I mean, today you open up an independent hotel, and guess what? It's a new brand, right? Way too many of them out there. I've heard, without identifying specifics, I've heard franchise sales folks from a major brand family acknowledge that they couldn't tell me the difference between brand X and brand Y within their family of brands, which to me says it all. Last thing I would say is it's kind of interesting if anybody was at the NYU hotel conference, investment conference back in June, and if you weren't, you should Google this, but Barry Sternlicht was a guest presenter, and he's convinced that the brands are going to be facing a huge challenge because with social media today, an independent hotel can compete very well against branded hotels, right? And if you think about it, it's all about experiential travel today, and right, the notion of staying in a I stayed in a cookie cutter courtyard last night. And by the way, I was shocked at the lack of cleanliness and just how dated it was. I don't know where I'm going with this. Anyway,
Well, no, just to echo on your point, I think or your prior point, it's all location. It's street corner to street corner. So if you're in a good market with a good location, I don't know if it makes sense to pay 10% of your top line to a brand. We've got a deal in Nashville that, they're going to have to put a significant amount of money into keep a brand for a relatively short amount of time. And I think for our clients in that scenario, I don't think it necessarily makes sense for them to do that when, the downside of losing the flag is probably not that great, just considering their location.
let's also not forget that, and this is generally speaking, it's not across the board, but hotel opportunities that become available completely unencumbered with either management and or brand, right, compared to an encumbered asset. It's not that one's better than the other, but there's definitely more buyers and investors out there looking for fully unencumbered than encumbered assets, and that tends to drive up pricing of unencumbered assets.
Next, we're going to go to Kyle to finish off on, are you seeing any of your clients going independent? Steve Barth, where are we on time? Great. And then we're going to come back to everybody on, I had OTAs, I would like to talk about that. Dan introduced social media, and then I'd like to talk about risks and trends. But first, Kyle, based on all these comments, what are you seeing with your clients?
I think that there's a comfort factor when there's a brand involved and there's a knowledge that you have a reservation system. We talk about loyalty programs. I'm a Marriott guy. So, I wonder, Marriott has a new conversion brand for older hotels, and it's called City Express. Like you were saying, I'm sure no one has heard of it. However, I might stay at a City Express because I want the points. So I think to an owner and an investor, there's a comfort level to that. But to Dan's point, having the flexibility to be able to choose which brand, I think, is a very important factor, if possible.
Great. First, Hector, OTAs, social media, are they changing? Are you seeing the same thing Dan is seeing? And is Expedia still driving the market?
The way I'll answer the OTA question is I think they have a position in the market. I think as either an owner or an operator, when you tend to rely too much on OTAs, that's when you may come into an issue. That's why you should have a revenue management team to be able to help you figure out what the best channels are during specific times of the year. I'm not a believer that they are bad. I think that they serve a purpose, and it's just how you use it's just how you implement and use your OTAs, your different OTAs within your system.
Jared, I'm going to add to that same question, but taking Brad's information, and I think we're obligated in every session for the next couple of years to talk about AI. Are you feeding that information in? Are you feeding revenue management systems? So same question, but add AI if you can.
Yeah, I think I don't have as much exposure, I think, to the OTA component as like the operational folks would. I guess anecdotally, I haven't booked on an OTA in forever. So I think maybe the brands have done a good job of pushing people into, brand.com. From an AI perspective, it's definitely the trend of the future in terms of, feeding data. We haven't really fed any data into AI. We have, some, like everybody probably has some AI, internal systems that we can use that is a real benefit and saves time in terms of, looking at, say, summarize this, contract or whatever. Obviously, you still have to verify and read everything yourself. I'd be interested in your thoughts. So I've heard that there are some lenders who say you have to, in your engagement letter, you say, we did not use AI at all to put together this appraisal or anything.
That is a recent phenomenon, correct. I think the whole AI conversation is interesting because I'll be the first one to admit I understand from 10,000 feet what AI is, but once I get below that, I don't know much about it. And candidly, I heard somebody say recently, and I like the term, that what we plan on doing at LW is be fast followers, right? So we're going to let everybody else figure it out, and we're right behind them. And once they figure it out, then we're going to jump on the bandwagon, vis-a-vis AI. What else? We were also talking about OTAs, online travel agents. I don't know why anybody would ever book through an online travel agent. It makes no sense, right? If you have a problem, right, who are you going to talk to? The OTA, right? You want to talk to the hotel, and they're going to tell you, sorry, you didn't make the reservation with us. Go talk to them. Listen, the hotel industry, unfortunately, has consistently been behind the curve when it comes to not only embracing technology, but creating it. Right? If you remember way back, well, when did OTAs come around? They came around during the, actually I just learned something the other day. GFC does not stand for Great Financial Crisis, it stands for Global Financial Crisis. I just found that out the other day. Anyway, call it whatever you want. The GFC was horrific for the lodging industry, and that was at the same time that technology was such that OTAs, online travel agents, came around. And the hotel industry was like, oh my God, this is the greatest thing since Swiss cheese. This is how we're going to fill up rooms. And then as we came out of that horrible recession, the sector woke up and realized, like, wait a second, what did we just do here? We gave up control of our most precious commodity, the guest, connectivity with the guest. And so we've had that sort of tug of war ever since. The hotel companies are making a lot of good ground to get that control back. And I read somewhere that by 2030, there's an anticipation that brand.com will exceed OTA bookings. And then social media, yeah, I mean, it's a thing. And like Barry Sternlicht said, with social media, you're able to take an independent hotel and with influencers and really make a good go of it and not have to pay all the fees that go to a brand.
Right. I think OTAs certainly are still around. People use them as a starting point. Where are the deals? Should I fly United, Delta, et cetera? I'm not sure we figured out bundling yet. I still will take a good look on a bundled deal just to see what's out there. All right. We're going to have a final session 4, on risks, gremlins. I would like our panelists to talk about risk gremlins and then what they're seeing for the future. But first, Kyle Stevenson, you've got a deal going, you're representing the seller, buyer comes along, you're marching down. I'll start. Lawyers bring in a purchase and sale agreement that has onerous reps and warranties, or aggressive reps and warranties, and chill the deal. I'm sure you see that often. Lawyers, finance, what gets in the way of a deal that you think is marching towards a closing?
Yeah, I would put lawyers at the top of the list. Sorry.
That's fine.
No, there's another dynamic that happens once you get to the PSA that can sometimes derail things. Lenders too. Many times the buyer's expectation of what the lender would do for them and the reality may shift during the transaction. And then the other thing that's another kind of unknown until you get into it could be third parties. We were selling a hotel for a lender, and the lender had foreclosed on the property, but they weren't aware that there was an open case for the environmental protection of that state that came up during the buyer's diligence because the previous owner had never filed the proper forms. So, woof, okay. I mean, that's one that can just be a deal killer. So it can be these third-party things that none of us have any control over.
Going back to the lawyers, I had a colleague who said everything costs something. If you put in an aggressive term, you might chill the deal, or it might cost more. To consider that, I try and tell the students, but maybe the clients want that aggressiveness, maybe the lawyers, but there we are. Anything on risks, gremlins, or what you're seeing for the future? And the future being 18 months, 3 years.
Yeah, and in terms of risk, I would say that nobody here has a crystal ball, or at least I don't have a crystal ball. But for where we're at in the cycle and what's happening just across the U.S., I think that the way to look at it is that costs are going to remain high, and depending on what happens with inflation, they're going to continue to go up. And that doesn't bode well because, recently STR just came out with their most recent reforecast for the end of the year, and that's not looking well at all. I mean, top line isn't growing as fast as those expenses are. And fast forward into 2026, I mean, only time will tell what ends up happening with those top line metrics based on, the current environment, let's put it that way. So yeah, that's what I'm seeing.
Go ahead, Jared.
Yeah, same. I think they kind of play into each other. Like the amount of time that it's taking to get PSAs done has really just blown my mind at how long it's taken. And it's not the financing. The financing's been pretty strong. I think it's partly that buyers know that there's not maybe a lot of other buyers standing in the wings, and so they're taking their time to get as much diligence done before they sign a contract as possible. I think the other kind of component, the challenge to it is we're in a period where fundamentals are generally flat to down, and so you're going through this process at the same time of top line coming down and NOI coming down, which creates some challenges, I think, for a buyer as they're working through that process. Our CBRE house view was adjusted down for this year. I think we're looking at a slight contraction in occupancy nationally, with like 1% rate growth and flat RevPAR, and then a couple 2% up in RevPAR in 26. So. I think the thing that's really going to be driving at least deals going forward is a lot of that pressure from investors who are looking at those fundamentals and say, every year we hold this is just going to be a hit on our IRR. So.
Dan, the Fed's going to be meeting soon, maybe to lower rates. We're seeing inflationary pressures for a variety of reasons. Construction costs are high. Any of those impacting how you look at the near future?
Well, sure, all of the above. You know what? At the end of the day, I heard a term recently, a transient uncertainty. Think about it for a second. What does that mean, right? And, it's interesting. At the beginning of this year, STR, and this is not a knock on STR, the point that I'm trying to make is I don't know, and guess what? None of you know either, okay? At the beginning of the year, STR was projecting, I forget the exact number, but an increase in RevPAR of, 2-3%, something like that, right? Then we had Liberation Day, and it was like, oh my God, the world's falling apart, right? And all the public companies, airlines, hotels, everybody was adjusting, or not even opining on where they thought their earnings were going to be. This is early April, right? And here we are today. And we have new agita, right? People already forgot about Liberation Day. The bottom line is we live in an uncertain world. Life is uncertain, right? You can cross the street, you don't know what's going to happen. With all that being said, I'm going to harken back to what I articulated earlier, that the hotel business is a very complicated business. High fixed costs, high labor costs. A lot of potential volatility, right? But you get rewards for taking those risks, and the key is to buy right? You make your money on the buy, not on the sell, right? And I keep coming back to the same thing. It's all about your basis in a deal. Again, that Blackstone, the Allegiant, I forget the name of it, Sunseeker on the west coast of Florida. At 25 cents on the dollar, the thing never made sense to begin with, right? But at 25 cents on the dollar, there's a shot. And you know what? There's probably no downside at 25 cents on the dollar. The land's probably worth 25 cents on the dollar. So hopefully I answered the question.
Great. Thanks so much.
But ladies and gentlemen, thank you very much. Got a couple of closing remarks I'd like to just provide everybody and give some thanks to our folks. So a big thank you to all of our supporters. As you see on the screen there, we literally could not do these programs without you. So thanks to all of our supporters. Thank you very much. And then can we give a round of applause to all the panelists that spoke this morning? That was great. And how about a big round of applause to Stephen Shapiro, moderator extraordinaire. And we're going to clap even though he's an Orioles fan. And I'd like to say thank you to the Army-Navy Country Club. I think they did a terrific job as always. So thank you, guys. If you're so inclined, we'd love to see you at our program in May 13th and 14th in Houston. So ladies and gentlemen, we're going to have some last moments to say thank you for joining us.
As stated during the beginning of this presentation, the link to initiate the certificate process will be displayed momentarily. My Law CLE would like to thank you for your participation in today's presentation.